Welcome to the InterMarket Analysis video update. This is a weekly video where I look at two main things. The first thing is the valuation of the S&P 500. I look at that on a historical basis and then on a forward-looking basis as well. Then the other area is where I look outside of the S&P 500 at other indexes, other sectors, other markets to see what's going on there, because sometimes we can get some insight for the S&P 500 by looking at other markets. This is being prepared for Monday, April 22nd. The first area is S&P 500 valuation. This first chart looks backwards. We use a PE ratio. We have a range of 10 all the way up to 15 and then 20. And when the market is above the level of 20, it's considered to be expensive on a historical basis. On this chart, we have been pulling back with the S&P, so we've been coming down just a little bit, but we're still well above this red dashed line, which is a PE ratio of 20. When we get to 20 or above, the market is considered to be expensive. However, we can stay like this for years at a time. We don't use this to make decisions. We just use this to get some insight as to what's happening in the S&P. Down below, I have a little easier to see chart where it's the difference between the S&P and the PE ratio of 20. When we're above zero, that means that we're expensive. And even though we're pulling back, we're still well above that 20 level. Here's another look, giving you some perspective with some historical events that have occurred over the years and what the different valuations were at that time. Then we look at this a little different way by using the Shiller PE ratio. This is also called CAPE, C-A-P-E, or just PE 10. I've seen it that way before. This was developed by Robert Shiller, and this takes more of a smoothed approach over a period of time to come up with a valuation. Right now, we're coming in at 32.98. Well, to get some perspective, we look at a historical chart to see where we've been and where we're at right now. And then we can look at the median and the mean, and we're just under 16 for the median and just over 17 for the mean. So even with the declines that we've seen on a historical basis, the S&P is still considered to be expensive. But the market doesn't do that. They look forward. And so we look at another area called the forward PE ratio. This is based on analyst projections and forecasts and things like that to come up with what they think the PE will be going forward from here. And then that's also calculated against the current price. Right now, the S&P, that's the red line, it's a little bit above 20. So we're slightly expensive even on a forward-looking basis. To get a little bit more perspective, we also see the mid caps and the small caps, which have been under pressure. They're falling back a little bit too. The mid caps are coming in at 15.3, so they're more fairly valued right now, where the small caps are at 14.5. They're actually tilting a little bit towards the inexpensive side. And here's a chart that I found at Isabel Net blog charts. This is another way of taking the Shiller PE ratio and just measuring it not only against US stocks, but then looking outside of the US. The black line, this is the valuations for US stocks. The red line, this is emerging markets. And then we also get developed markets, that's DM. If you take out the US, that gives us the blue line. So even comparing it to other markets, the S&P is much higher valued using the CAPE or Shiller PE ratio than stocks in other countries. This also looks at how do bonds and stocks interact with each other. In a general sense, this chart is just saying that when we're getting a real high reading like we are right now, bonds and stocks move together. Well, sometimes that's the case. And we have been seeing that as interest rates have been going up, that's been putting pressure on stocks. And that means bond prices are going down. Now, we did see some disconnect over the last few months where interest rates were going up and stocks were going up at the same time. But for the most part, we want to keep an eye on that because the market is really fixated on interest rates right now. When it gets to the point where they're trading in opposite directions with each other, that's when we're using bonds to hedge against any losses that we might see. We're not in that area right now. We're in the area where bonds and stocks tend to move more with each other. Then we look at the leading earnings indicator where we have the blue line and it's starting to come back up, showing some positive growth here on a year-over-year basis. And then this is Morgan Stanley and they think that earnings are going to continue to look good going forward. So this could justify higher stock prices. And then this is looking at oil and just what Goldman Sachs thinks that they'll see as far as oil prices. We've seen oil really bouncing around, especially this last week. And then over the last couple of weeks, as tensions have really increased in the Middle East, but they still project this actually coming down. Then looking at valuations and how they've stayed higher than the macro backdrop would normally suggest. This is just saying that stocks tend to be more overvalued at this time. Now, another area that we look at is growth versus value, and we might be starting to see a bit of a shift. We saw this shift at the end of 2021, and that led to a difficult time in 2022, where the real smart money and a lot of investors were getting out of growth and getting into value, and that's more defensive. When you want to buy low and sell high, those are growth stocks like Nvidia, Microsoft, Amazon, the big magnificent seven stocks. Those are growth stocks. When the market turns more defensive, you get into things that tend to hold up better if we're going to be running into a difficult time. We are seeing that shift right now, but it can take a while for this to develop, and we're still trying to figure out the weakness that we've seen recently in the market. Is that just a pullback before we finally hit support at some point and then bounce up out of that? Or are we seeing the whole climate really shifting over as the Fed has been adjusting this idea that they're going to cut interest rates in 2024? We're kind of in between right now as we're evaluating things. The first thing that we look at is growth, and this is still in an uptrend and have been doing quite well. We look at growth all by itself, but you can see where it has been pulling back enough to fall underneath its 50-day moving average. And we're seeing that across different markets, the big stocks, different indexes, they're all dropping below what typically has been good support, the 50-day moving average, and starting to come down. So we are seeing some weakness here. Then we look at a pure value index where this has actually been going up. And this is part of that shift that we might be seeing. Folks are selling growth and they're buying value when you just look at this index itself. Where we can get some insight is we do ratios between the two, where growth had been outperforming value, but now we're seeing that ratio really dropping off. Let me look at an inverse of that chart because sometimes there are slightly different calculations that are used. This is showing how value has been underperforming growth, but lately has been really bouncing back up. We're going to watch to see if that still continues. Now we look at this across multiple different ETFs and indexes where growth has been outperforming value, but pulling back. Now, here's an inverse where value had been underperforming, but starting to show some improvement. And here's another look at that peer growth and value index taking a ratio where it's still in an uptrend, but we have been seeing some declines. Here's another little shorter term look showing how value had been underperforming, but starting to make a comeback. There's another look, also growth outperforming, but showing some weakness. And then here's using some ETFs to do a ratio where growth is still doing okay here. It's been going up as the rainbow's been going up, but you can see we've come all the way down almost to this long-term moving average. This is a 250 period moving average. If we really start to drop below that and stay below it, we might start to see more of this shift actually taking place. Then here's that same thing, only showing value to growth, where it had been really going down. Now it's starting to come back up. And we break it down a little bit and look at just small cap growth to value. It was looking a lot better when the market was more positive about the Fed actually cutting rates, and that can really benefit small cap stocks. But lately, since about the beginning of March, we've been really falling back here with this ratio when we look at small cap growth to value. We also keep an eye on the mid caps. This has been a stronger area in the market, but now we're seeing some weakness in this ratio. Also with the S&P 500, the growth to value ratio was doing pretty good. It's still in an uptrend, but it has really been falling back lately. We keep an eye on inflation. We're going to get the initial GDP this upcoming week. We're also going to get the core PCE report on Friday, and that will give us an idea, at least where the market is standing as far as inflation. But this is a monthly chart of the CRB index, which are commodities, and they've been kind of in favor lately. And so we're seeing where the monthly chart anyway, is above the moving average, and the red line, which is the moving average, is starting to turn up. We're not really showing a big difference here. When we do a ratio between inflation and deflation, it has been coming up as commodities have been going up so far in 2024, but it's still below a declining moving average. Here's a daily chart of the CRB index where it is in an uptrend, and we've seen a recent golden cross. And we look at the Baltic Dry Index. This has been chopping around, not really giving us any insight lately. It's still in an uptrend. This is what does it cost to ship products specifically in the Baltics. And this is just one index that is used to measure things all over the world. When this is going up, that can be more inflationary. When this is going down, that tends to be more deflationary. Some other markets we just look at just to get an idea where they're at. Aluminum is now starting to see an uptrend here, where corn continues to decline. Wheat is also declining. Fertilizer ticking up a little bit recently, but has been dropping off over the last year or so. Oil, which has been quite volatile lately, it was really spiking up as there were tensions in the Middle East. Now it's starting to fall back again. Gas is in an uptrend, which we all feel that anytime we fill up our cars or trucks. Diesel is actually coming down a little bit. We keep an eye on this because this is for trains and 18-wheelers, and if this goes up, then it costs more to ship products around. Heating oil continues to decline, and natural gas it's really going low here. It's in a pretty solid downtrend. Copper, this is used as a barometer of the economy. As a general rule, when copper's going up, that means the economy is looking better going forward. And we've been getting some stronger than expected economic reports, and we're seeing copper go into a pretty solid uptrend lately. But then we're also keeping an eye on gold, and we do a copper to gold ratio. And copper has been outperforming recently. It's spiked up, but for the most part, it's been underperforming gold when we look at this ratio. And here's a longer term look. The black line here, this is the copper to gold ratio going back to 1980. And then I plot the 10-year and the 2-year yield on here as well. Typically, we've been seeing this ratio going down as copper has been underperforming gold, but we're starting to see interest rates begin to go back up, and we're wondering, again, is the market shifting into a different kind of an environment? Here's looking at the gold ETF, which is in a solid uptrend, and a lot of folks, the gold bugs, they're just sure that it's going to keep going all the way to the moon. Silver has also been doing well lately, and it's in a pretty solid uptrend. And then we look at the closing value for gold, which has been going up, and silver going up, and the correlation between the two, because sometimes this gets a little out of line with each other. Right now, they're having a pretty strong tendency to go in the same direction at the same time, either up or down. The higher we get with this reading, the stronger the correlation between gold and silver. And we have a gold to silver ratio on top. When this is going up, that means gold's outperforming silver. When this is going down, that means silver's outperforming gold. In the middle, we plot the US dollar index. And then sometimes, not now, but sometimes we can get some insight when the correlation is strong between the two. They're actually having a little bit of a tendency to go in opposite directions right now. Sometimes when this correlation is strong, and if we see the gold to silver ratio going up, that may also give support to the dollar, and the inverse of that is also true. Keep an eye on the dollar. It is in an uptrend. It got up into the 106 area, but it ended up closing just below 106 after Friday. But it's in an uptrend when we look at the daily chart. It's also in an uptrend on the weekly chart. And this goes back and shows how we're breaking out above this downward sloping trend line as the dollar's been seeing some strength. Here's the euro, which has been really underperforming. In fact, it just saw a death cross compared to the US dollar as it's been under pressure, where the dollar has been showing some strength. We also keep an eye on the Japanese yen, which is also in a downtrend compared to the dollar. Here's a breakout chart showing how the euro has been really going down. They're not quite at par yet, or where they're both the same, but if you ever wanted to take a trip to Europe and want to get a more favorable exchange rate, now would be a time to do that. We are seeing a downward trend now start to develop when we compare the euro to the dollar. Japanese yen is also in a downtrend compared to the dollar. The British pound has been weakening, but we have not seen a cross yet here. We haven't seen the death cross, so it's still in an uptrend. And we look at some other indexes. I do show this one in the daily video. We take the S&P 500, which is a weighted index, and then we compare it to the S&P 500 equal weight, where all stocks are treated the same. It's not weighted. And we were really starting to come down with the red line as the broad market was underperforming. But then over the last couple of sessions, this has been going up a little bit as the S&P has been going down, as some of the mega caps have really been getting hit hard. We look at a ratio between the equal weight and the S&P 500. I have a different way of looking at this. When this is going down, that means that the equal weight is underperforming, and it's not really moving in any kind of decisive direction right now. Then we do another ratio between stocks, the S&P 500 and the CRB index, where stocks had been really outperforming, but lately they're starting to pull back, coming down to the 200-day moving average here with this ratio. Here's an inverse of that same thing. Commodities were underperforming. Even though commodities were doing better, stocks were doing even better than that. Well, now we're not seeing that right now. And so this ratio is starting to come back up to the moving average. Then we look at the NASDAQ 100, which has been the real leader, and we compare it with the S&P 500, which also has been doing well, but lately under some weakness. And this just shows that recently the NASDAQ 100 is actually underperforming the S&P 500. Here's the S&P 100 compared to the S&P 500. It is coming down a little bit, but not really breaking down like we're seeing some of the other ratios. Here's the NASDAQ compared to the S&P 500, where it shows the NASDAQ had been outperforming. Now it's really starting to drop off. And we're waiting to see, is this going to continue? Is this the start of something? Or is this just something that's going to occur, get dealt with, and then we're going to see these ratios turn and go back in the other direction? The NASDAQ 100 to the NASDAQ. NASDAQ 100 had been really outperforming very strong, but now has been pulling back. And then we look at mega caps, the really big stocks, and compare it with the equal weight index. The mega caps were really outperforming, but now are starting to pull back. We do a ratio between the small caps and the S&P 500. When this red line is going down, which it is now, it means that small caps are underperforming. We look at another measure, also showing that small caps are in a downtrend compared to the S&P 500. The biggest software companies, they are in an uptrend, but have also been pulling back as we've been seeing some weakness lately. The mega caps actually fell underneath their 50-day moving average. They have been in a really solid uptrend. What we're waiting to see notice back in October when we came almost down to the 200-day moving average, is something like that going to happen again? Or are we going to find some support in here and actually turn and go back up? Or are we going to continue to go down and even fall below the 200-day moving average? Take your pick, and you can justify any stance right now. We just have to follow the charts and see how they play out. The robotics and AI ETF has been in an uptrend when you look at it by itself, but lately it's been under pressure. This is kind of the craze. A lot of people are talking about this, and they're really into this ETF. Well, lately it's been showing some weakness. But when you compare it to the tech sector, it's actually bouncing up a little bit. At least it did on Friday. It was starting to outperform earlier in 2024. Then it was coming down. It was underperforming. And as the tech sector has been under pressure lately, it's been bouncing back up just a little bit. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities. Now, the transports and the utilities have both been under pressure. Most of the strength that we've seen has come from the Dow itself, and it's holding up okay. It was actually unchanged on the week last week, where a lot of the other indexes were down, but it has been falling back a little bit lately. However, it's still in a longer-term uptrend. We compare the S&P 500 with short-term bonds that are 1 to 3 years. Stocks have been really outperforming, but as interest rates have been going up, this is starting to pull back down a bit. Then we look at the S&P 1500, which has been going up compared to bonds, but lately pulling back. We look at another broad market measure and compare it with further out bonds from 3 to 7 years. Stocks have been outperforming, but now we're seeing some weakness. And then the total U.S. stock ETF, this is 2,651 stocks. It is in an uptrend. It's been pretty strong, but it did come down and fall below its 50-day moving average. Low volatility stocks, which are in an uptrend, but they've also been pulling back a little bit lately. But when we do a ratio between the S&P 500 and the low volatility ETF, the low volatility ETF has really been underperforming, but we're seeing it bounce back up. And this is one of those more defensive things that we want to keep an eye on. If this continues to go up and we actually turn into an uptrend, that means the market's getting more defensive. We're just waiting to see if that's going to develop, or is this going to work itself out and continue to go down. Then we look at the tech sector and compare it with 3 to 7 year bonds. It is in an uptrend, but it has been pulling back, just like we're seeing on all of our different charts. Then I show this in the daily video as well. This is what I call the advanced decline line studies. We look at the NYSE just common stock, where it's actually turning up a little bit. We're seeing a little bit of an improvement on some of our daily indicators. Even though we were down on Friday, we're seeing a little bit of a turn up, and we're wondering, is that going to develop into something, or is it something that we could ignore at some point? But we did come up just a little bit with the NYSE advanced decline line. We turned up a little bit with the S&P 500, the mid caps and the small caps, but all of these are below their moving averages. So this is showing more of a cross the market breakdown as we've been under weakness lately. Here's Dow theory, which just set an all-time high with the Dow not too long ago, but it's been pulling back. And the transports, this is a non-confirmation. We set a recent all-time high with the Dow. We did not set a new all-time high with the transports. And the folks that are more negative on the market, they really pick up on this, and they're just saying, look at the non-confirmation here. It can take a little bit of time for this to work out. But right now, yeah, it's more negative because these did not confirm each other. Utilities have been under a lot of pressure, but lately have bounced back up. Here's a look at the transports itself, just individually, where we're just having a lot of trouble. At best, we've been going sideways, but lately we've been seeing some weakness in this index. Then we do a ratio between the transports and the S&P, where the transports have really been underperforming, even though they bounced back up on a relative basis in Friday's session. We look at a ratio between the Dow and the transports. When this is going up, which is what it's doing now, that means the Dow is outperforming the transports. And we look at the relationship between the S&P 500 and the transports. It's pretty high right now. So they're having a tendency to go in the same direction at the same time. Right now, that means down, as both have been under pressure. Then instead of using traditional Dow theory, we also look at what can be called a new take or a new Dow theory, where instead of using the Dow, we use the S&P 500, thinking that that might be a better representation of the U.S. stock market. And then on the bottom, instead of using the transports, we use the NASDAQ, which is more tech-oriented, and that's more like the U.S. economy. And then we look for divergences and convergences here. They're both going down right now after setting all-time highs. So we're not really seeing any kind of divergence at the present time. They're both going down. Then we break that down a little further. Instead of using the S&P 500, we use the S&P 500 equal weight, and that's been coming down lately. And then instead of using the NASDAQ, we look at an equal weight ETF of the QQQs, which represent the NASDAQ 100. That's also been coming down. And we're seeing this coming down a little bit stronger than what we're seeing with the equal weight here. Just as the big stocks that help the market go higher, they're also starting to take the market lower. This is another broad market measure called the Wilshire 5000. It dropped below its 50-day moving average as well. It was actually up slightly on Friday, but it has been showing some weakness. The FANG index, this is Facebook, Apple, Amazon, Netflix, Google, Nvidia's in there somewhere, and the big high flyers, the Magnificent Seven. It's still in an uptrend, but it fell underneath its 50-day moving average and has been showing some weakness. And then if we do continue to fall, I'll be trying to find some area of support if prices keep going down. ARK, which is a very popular ETF, it really didn't participate on the way up, but it's kind of starting to participate on the way down. It was down almost 10% on the week, and it was down in Friday's session. It's still in an uptrend, but it has been pulling back. Then we look at a monthly chart of the S&P, and we compare it with a a global mix of stocks and take a ratio of that. And these stocks are in Europe, Australia, Asia, and the Far East. Over here, we are pulling back a little bit, but we're still above this moving average, and the moving average is going up. That's showing that the S&P 500 is outperforming global stocks. We're turning down just a little bit with the momentum here, but this also shows that the momentum has been positive as of until recently. It looks like it's rolling over a bit. The total bond ETF. Bonds have been under a lot of pressure based on price, coming down to their 200-day moving average, but still in an uptrend. If they bounce up off of this and start to go up, that might start to bring interest rates down, which could give some support to stocks. The World Bond Index that we look at, it's really chopping around right now, but it's still in an uptrend, but it could easily develop into a death cross here if we continue to see more weakness. We look at a monthly chart of stocks versus bonds, and this just shows that stocks continue to outperform even though they've been pulling back. Here's a daily chart of kind of that same thing, but inverse, showing how bonds are underperforming stocks in the longer term here. We look at high yield corporate bonds, also called junk bonds. They tend to follow the stock market. And we have been in an uptrend and we continue to be in an uptrend, but this also fell below its 50-day moving average, showing some more intermediate term weakness. Investment grade bonds are more conservative and not as risky as junk bonds. They're in an uptrend too, but they came all the way back down to their 200-day moving average. And we do a ratio between riskier bonds like junk bonds and more conservative bonds. This is still going up as folks are favoring the riskier bonds. If we see this going down, that means folks are getting out of the junk bonds that have more risk, but they also have more yield, and getting into more conservative bonds because interest rates are coming down and folks want to lock in those higher interest rates and let those bonds just ride for a while. Right now, we're still seeing this going up, so folks are favoring junk bonds over more conservative bonds. And we do a correlation between the two, showing that there's a pretty strong correlation between stocks based on price and bonds based on price. Here's the Dow Jones Corporate Bond Index, which is in an uptrend, been going sideways for most of 2024, but has been falling back lately. The 10-year yield, we're wondering, are we going to get all the way back up to 5%? That's what we hit last October. We finally bottomed, and then interest rates started to come down. We have been inching our way back up lately. We're not at 5% yet, but as interest rates have been going up, this has been pressuring stocks. This is a long-term look at the yield for the 10-year, where we were seeing a series of lower highs and lower lows for about 40 years. Now we're probably shifting into a new kind of an environment where we may see higher interest rates. This is a chart that I showed way back in October, and I've been repeating this over and over. We came down last October and hit this low reading right here, but that was on good news. The market had developed this idea that we were going to have a soft landing, meaning that the economy was not going to go into a recession and that the Fed was going to come in and start cutting interest rates. Well, that got kind of finished at the beginning of 2024. Then the market started to develop that again until a few weeks ago. And now that's starting to go away again as we're getting these strong economic reports. So we don't know where we stand with that right now. The reason I bring up this chart is the other two times that we had really low readings like this, these were negative things that happened. Where the thing that happened last October, that was a positive thing. And that's kind of strange. Now, it didn't play out the way this chart thought it would, but we're still keeping an eye on that. And I'm just waiting to see if there's going to be an update of this chart at some point. There's the 30-year yield, which is also going back up as well. And then we look at the S&P 500 and compare it with the 10-year yield, where the S&P 500 had been outperforming, but lately has been pulling back as interest rates are going up. And then we look at 3 to 7 year bonds and compare it with stocks, where the bonds have been underperforming, but lately they've been bouncing up as interest rate fears are starting to come back into the market. Junk bonds also tend to follow what happens with stocks, coming off of a recent all-time high, but also dropped below their 50-day moving average. Then we look at junk bonds and do a ratio with more conservative bonds. And this is showing that folks are still preferring junk bonds. Now, if we see this go down, That might mean that interest rates have topped out. Folks get out of the junk bonds and get more to conservative bonds. Here's an ETF of the 7 to 10-year bond, just showing based on price, we've dropped below the 200-day moving average. We're still in a longer-term uptrend, but we're below 50 with the RSI, and the momentum continues to be negative. Here's a daily chart of the yields, where you can kind of eyeball this and see that interest rates have been going up since about the beginning of March. This is a weekly chart looking internationally, where US rates are the highest, followed by UK rates, and then German rates, and then the red line are Japanese rates. We look at a thing called the MOVE Index, which measures the volatility of bonds, where it's really been going up as bonds have been going down. We also look at the VIX, which measures the volatility of stocks, which have also been going up, and they have a pretty strong correlated relationship right now. So if bonds are going down, or at least the volatility is going up or down for bonds, it's probably going up in that same direction for stocks. Then we look at a monthly chart of the 30-year price of the Treasury bond, where it is still in a longer-term downtrend and below the moving average. We do a ratio on the bottom between the 30-year bond and the CRB, showing that bonds are still outperforming. But this is a monthly chart, so it could take a while to adjust. Then I look at different sectors, and there's 11 sectors that make up the S&P. And I just have these loaded in here based on the alphabetical version of their symbol. So I look at the sector by itself, and we can see here the materials are in an uptrend, but they have been pulling back. They've come down to their 50-day moving average, and so far this level is held. Then on the next chart, we do a ratio between the materials sector and the S&P 500. Because materials have been holding up a little bit better, they're still in a downtrend, but they have been bouncing back lately. This has been one of the better areas of the market recently. Communication, another real leader of the market as we've been going up. It's still in an uptrend, but we fell below the 50-day moving average. Then we do a ratio where communications have been under pressure. The S&P has been under pressure. But even with the pullbacks that we're seeing, communication is still holding up better than the rest of the S&P. Energy, been really strong lately, but it's also come back down to its 50-day moving average. We do a ratio compared to the S&P, where it's still in a downtrend, but it's really been bouncing back up as energy's been one of the better performing sectors in 2024. The financials, also in an uptrend, actually fell below their 50-day moving average and now trying to come back up to their 50-day moving average. And when we compare it to the S&P, they're actually outperforming. So they're holding up a little bit better now. We look at industrials, also in an uptrend, coming down slightly below its 50-day moving average. But on a ratio basis, the industrials have been outperforming the S&P. Tech, one of the darling areas, it's in an uptrend, but really pulling back now. We're seeing a lot of weakness right now in tech, and it's actually starting to underperform the S&P on a short-term basis. On a long-term basis, it continues to outperform. The staple sector, the things that you have to have, like toilet paper, toothpaste, no matter what's happening in the economy, this is going into a pretty solid uptrend, pulling back. Now it's starting to come back up, and this is a more defensive area. So we'll be seeing if this continues to go up, that could mean that folks are shifting over and being more defensive in the market. We look at a ratio where it has been underperforming the S&P, even though staples by themselves have been up. Compared to the S&P, it's been underperforming, but lately we're seeing this ratio really start to change. Real estate, which has been under a lot of pressure as interest rates have been going back up, by itself, the sector is in an uptrend, but lately it's been showing some weakness, dropping below its 200-day moving average. We do a ratio between real estate and the S&P. Still, it's bouncing up a little bit here, but it's continuing to underperform. Utilities, which are in an uptrend by themselves, they've been chopping sideways a lot, and they can get pressured as interest rates are going up. But when you compare it to the S&P, longer term, it's underperforming. Lately, it's been showing some signs of improvement. And then we do a ratio between the S&P and utilities. When this is going up, typically the S&P is going up. Now this is starting to go down as the S&P has been under pressure. Healthcare, another thing that you have to have no matter what's going on in the economy. It's in an uptrend by itself, lately seeing some weakness and really underperforming when we compare it to the S&P, even though it has bounced back recently. Discretionary, the thing that makes life fun, in a longer term uptrend, fell below its 50-day moving average and now is starting to fall below its 200-day moving average. And when we look at this on a ratio basis, this really helps stocks in 2023. But since Tesla's been under a lot of pressure, we've been seeing this ratio really going down and showing some weakness. Semiconductors. This was one of the areas way back in 2022. You can't really see it on here, but we started to see a golden cross right back in here. It was one of the first areas to turn positive when we were finally starting to bounce. Well, it's also been a stronger area and has been really helping the market to go higher, but now we're seeing some weakness in this area. We look at energy, which had been underperforming the tech sector, but lately it's been outperforming, but we're still in a longer term downtrend. We look at growth areas, buy low, sell high stocks, and compare it with bonds, much more conservative. And they're both, or this ratio is in an uptrend showing that growth is outperforming, but lately seeing some weakness. The tech sector, compared with the 10-year yield, tech sector had been outperforming, now starting to pull back. Here's an inverse of that same chart. The 10-year yield had been underperforming, but now starting to bounce back up. Discretionary to staples. This is in a longer term uptrend, meaning the discretionary had been outperforming, but lately we're seeing a real trail off in this ratio. And here's staples to discretionary, where staples had been underperforming, but now starting to bounce back. We look at gold to the S&P, and believe it or not, since everyone's talking about gold and everybody's all excited about it, it's still underperforming the S&P. Now, this could continue to go up, and if stocks continue to go down, we'll see this ratio continue to go up as well. But for right now, we have not seen a cross in this ratio. We compare gold to the dollar, where it's breaking out on the daily chart above this downward sloping trend line. High leverage loans, which are holding up okay for right now, they're still above their 50-day moving average. And if we were really worried about what was going on in the economy or that these risky loans would default, we wouldn't see this ETF going up the way it is. This is one area of the market that has been holding up fairly well. And we look at the NYSE composite, a broad measure. This has been in an uptrend, but fell below its 50-day moving average. All stocks, looking at U.S. stocks and international stocks, in an uptrend, but falling below its 50-day moving average. I sound like a broken record here. Emerging markets have pretty much been chopping sideways, but they're still in an uptrend. And we look at the Nikkei, which is the Japanese index. It finally broke out, set an all-time high, but has been pulling back since then. Microcaps, really small stocks, they are still in an uptrend, but starting to come back down to their 200-day moving average. We look at the home builders, and then we compare it with the S&P 500, and we see right now that they have a pretty strong correlated relationship, so we're not getting a lot of insight from this chart. Bitcoin, which went back and set an all-time high at 73,000, almost 74,000, but lately has been under pressure. However, it's still in a longer-term uptrend. And we look internationally, and this is using an oscillator called a KST, which can be a bit slower, where China, emerging markets, Europe, Japan, and the US all are in downtrends right now. So we're seeing pressure throughout the globe at the present time. We look at an intermarket analysis chart, which is the name of this video, where we see that oil has been doing the best going back to the beginning of the year, then gold, and now we saw a change this past week. This green line, that's the dollar. It's starting to outperform stocks, where stocks have been under pressure. Now, they're all positive going back to the beginning of the year, but we are seeing a little bit of change here. However, bonds based on price continue to be negative. Then we look at some correlations. We look at the S&P 500 and compare it to the US dollar index. They're having a pretty strong tendency to go in opposite directions. So if the dollar is up, which it has been lately, that can be pressuring stocks. If the dollar goes down, that may give some support to stocks. Then we look at a correlation between the S&P and oil, where they're having a tendency to go in the same direction. Now, as things were developing in the Middle East, we saw this correlation where oil going up was negative for the market, and that was due more to geopolitical tensions. There was a couple of things that played out this past week, but now we're seeing this correlation picking back up, where both the S&P and oil are going in the same direction, and right now that tends to be down. We look at the S&P 500 and compare it with the 10-year yield. where they're having a pretty strong tendency to go in opposite directions. If interest rates are going up, that can pressure stocks. We're seeing that same thing when we look at the tech sector to the 10-year yield. They're going in opposite directions. And then we look at the S&P 500 to the 2-year yield, also pretty strong tendency to go in opposite directions. Then we look at some long-term charts here. This is a monthly chart of the NYSE. Even though we're pulling back, we're still in a longer-term uptrend, and the longer-term momentum, as measured by the Copic curve, is still positive. This is a daily chart showing the NYSE record high percent index. It is falling back a little bit here, but it has been bouncing up lately. Then we look at a monthly chart of the S&P on top, which still is positive even though it's pulling back. And we look at another momentum oscillator, the PPO, where it's starting to look a little more negative. So this is a bit of a warning sign to us longer term. We look at a ratio between the stocks and the CRB index, showing that stocks are still outperforming. But this is a longer term chart, so it can take some time for this to actually change. Then we look at the S&P 500 and look at another global index where the S&P 500 is still outperforming. The KST, it was trying to cross more over positive. Now the lines are pretty much on top of each other. Then at the very end of this video, I list all those things that are positive and negative. And my definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. And the list is pretty long. Even though we're seeing some weakness, we haven't actually shifted over in our trends, at least yet. We have the growth indexes and value indexes by themselves. Copper, the British pound against the US dollar. Gold is in an uptrend, silver's in an uptrend, the dollar by itself is in an uptrend. The CRB index, the big software companies, the mega caps, the FANG index, ARC, the low volatility ETF, staples, the Dow Jones Composite Average. When we look at all the different areas of bonds based on price, even though they're showing a lot of weakness recently, they're still in uptrends. The tech sector and semiconductors also seeing some weakness, but still in longer-term uptrends. High leverage loans, the Dow, the NYSE Composite, and the Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, they're still in uptrends, even though they've been pulling back. All stocks, looking at US stocks and international stocks, emerging markets, and then Bitcoin. So our list is pretty long. We're still positive for right now, but moving averages lag, and it can take some time for these things to actually cross each other. So we'll just keep an eye on this and see if we continue to see more of a development that we've been seeing. Then on the positive, or excuse me, the negative side, this is when the 50-period simple moving average is below the 200-period simple moving average. The list is pretty short. We have the Japanese yen to the US dollar and the euro to the US dollar. Thank you. I really hope you found this helpful. Please feel free to check out the other videos. This is what I consider to be a supplemental video. It just goes hand in hand with the weekly video, but the real foundation of the videos that I put out are the daily video updates. Have a great weekend, and I will talk to you in the next video.